Hi, and welcome to Wealthion. I'm James Connor. And before I introduce you to our guest, just a quick reminder to subscribe to our channel, wealthion.com. We have some amazing interviews coming up in the coming weeks, all of which will help you protect and grow your wealth during these uncertain times. And the best way to be made aware of what's happening on Wealthion is to subscribe to the channel and also hit that notification button to be kept up to date on future events. And now I want to introduce you to our guest, Chris Mancini. Chris is an associate portfolio manager of the Gabelli Gold Fund, and Gabelli is a bottoms-up value fund based in New York and manages just over $29 billion in assets. Chris is focused on the gold sector, and we're going to get his views on whether or not now is a good time to invest in gold and gold equities. Chris, thank you very much for joining us today. How are things in New York?
Jimmy, they are good. They are good. Not too cold. 28 degrees this morning, but sunny. So very doable. And it's a nice respite after a super wet and cloudy and gray, week I think we had last week, which was miserable. So things are good in New York. Thanks.
Yes, it's almost like spring is in the air. Things are definitely looking up.
Yes, I hope so. Feels that way. Hopefully for the gold price too, but we'll see.
Chris, before we do the deep dive on gold, I want to get your thoughts on the broader economy and if there's anything that's concerning you right now or if there's anything that's keeping you up at night.
Yeah, I mean, I think that the big picture is that the Fed has done so much. There's been so much intervention by the Federal Reserve over the past few years in terms of the enormous amount of quantitative easing that they did in all different types of asset classes. And then the very swift and rapid tightening that they've undertaken in the past year or so as they've raised rates, and then they've also drained some liquidity from the system in terms of the quantitative easing. So, I mean, this has been a very rapid and very significant tightening of monetary policy, and it seems like everything's okay. But we are seeing some cracks beneath the surface. We're seeing kind of credit card delinquencies going up, auto loan delinquencies going up, the consumer saving rate going up. So it seems like everything's okay, and there is this kind of Goldilocks narrative going on right now. But it seems unlikely to me that that we will have gotten out of this type of enormous monetary experiment with very little material repercussions to the economy.
Very interesting viewpoints, Chris. Thank you for that. One of the things we try to do at Wealthion is provide investors with insights on how to protect and grow their wealth. And you and your team believe gold and gold equities can do that. And I want to begin our discussion right here. Why should investors own gold and gold equities? What are the benefits of doing so?
Well, the reason to own gold is as a hedge against the monetary authorities not getting everything right in terms of this Goldilocks scenario not coming to fruition. And so now the thing is that, what does that mean? What that means is that if the Fed does undertake more quantitative easing and essentially printing money, then it could cause an inflation like was caused during the COVID ordeal or as a result of the COVID ordeal. So we have seen prices broadly in the United States around 23% higher than they were at the beginning of the COVID ordeal. So again, it seems like we're in this scenario where the quantitative easing is here to stay, money printing is here to stay, and inflation might be here to stay. So currency debasement might be here to stay, meaning that as currency loses its value, hard assets like gold will maintain their value in terms of that currency. And the other thing to keep in mind is that these situations could happen quickly. So we saw with the failure of First Republic and Silicon Valley Bank, and then the other banks in New York, the Sterling Bank in New York, that happened very quickly. The Fed set up facilities in which it injected liquidity into the system of essentially printing money. And gold went up when that happened. I think that if we were to see a weakening in the economy now, like after we saw a very strong non-farm payroll number, if we were to start seeing weakness in those numbers, I think that there would be a narrative in the market that the Fed would start QE again. And so I think gold would run. So it makes sense for everybody to have a little bit of gold in their portfolio, again, as a hedge against like a Goldilocks scenario not transpired.
Yes, Chris, you mentioned the regional banking crisis, and I have to be honest, I almost forgot about that. That was almost a year ago, but it was amazing how the whole thing was contained relatively quickly by the Fed, and it did not spread the way a lot of people thought it would.
Yeah. Yeah, exactly. And I think that they did it through printing money, just like they were able to really contain the whole COVID ordeal, where the whole world economy was shut down. In this circumstance, the United States economy was shut down by printing money and buying assets. Now, again, that resulted in the prices of goods being 23% higher now than they were then. And, if other banks do start to fail in the United States because of either higher rates or delinquencies or commercial real estate, what will be the response of the Fed? It probably will print more money. So again, like they do contain these things, but there is an eventual cost, and to the degree that we stay in this cycle of kind of things are okay, then a crisis or a recession, and quantitative easing is the result. To the extent that we stay in this type of cycle, inflation will likely be here to stay, and gold will continue to kind of hold its value.
So, along that same vein, central banks have been large buyers in recent years of gold. In the last year, they purchased, I believe, over 1,200 tons, and there was just over 3,200 tons produced, so a relatively large amount. But maybe you can tell us why central banks have been so aggressive in acquiring gold.
Yeah, central banks are buying gold because, I mean, it highlights again the value of gold in a kind of similar or kind of ancillary way to how I was describing it. In that gold is an asset which is nobody's liability and can't be replicated, right? So we see with the inflation that took place in the United States and also around the world, like Canada too. It was because of all of the money that was printed, and as the money is printed, it causes the price of things to go up in those money terms, right? And so as the price of those other assets go up, or those just goods go up in money terms, gold also goes up in value. But we saw something a lot more concrete relative to the value of gold compared to paper currency in what happened in Russia after Russia invaded Ukraine. So after Russia invaded Ukraine, the United States and other European countries essentially confiscated Russia's US dollar and euro denominated reserves. So Russia held around $500 billion of reserves, and a portion of that was in US treasuries, a portion of that was in euro denominated bonds. And when after Russia invaded Ukraine, the United States and Europe said, we are not going to pay you back, essentially. So Russia loaned us and European countries money in terms of owning those bonds, and we said, look, we're not going to pay you back. So Russia thought that it had hard currency reserves, and it turned out that they didn't. And gold, obviously, they also held and still hold lots of gold. That gold obviously is in a vault in Moscow or wherever it is in Russia, and that can't be taken away, can't be confiscated. They don't have to worry that someone's going to pay them back. Lots of countries around the world are realizing what happened with Russia. And so China, for example, owns around $1 trillion of U.S. treasuries. And they're essentially lending us $1 trillion. I think that they saw what happened with Russia and are saying, hey, wait a second, is the U.S. going to pay us back? And so they're diversifying. They were the biggest buyer of gold last year amongst global central banks. So I think that they're going to continue to buy. I think that other countries are seeing that, and it becomes self-fulfilling as gold becomes more of the go-to, store of value, hard currency asset for central banks. It can be it can be kind of a self-perpetuating cycle.
Well, that's a very interesting point, and I'd be curious to know if Russia and even other countries were also buying Bitcoin for the same reasons.
Yeah, exactly. I mean, and that's the point. The answer is no. I mean, or at least not as far as we know, and I highly doubt that they were. Um, the thing is that Russia has gold reserves in the ground. China has gold reserves in the ground, right? So they can actually they can mine gold and add to their reserve base, add to their currency reserve base. The United States has the biggest reserve of gold in Fort Knox and the Federal Reserve in New York, but we also have actually very big gold reserves in the ground in Nevada, and various other places in the U.S. So no, I mean, like they are not going to buy Bitcoin as a store of hard value. They own gold, and they own gold in the ground. They'll continue to own gold, and that's a meaningful difference between Bitcoin and gold.
So central banks have been buying the physical gold. Now let's talk about what's happening with ETFs, both the GLD and also gold equity ETFs. What are you seeing there? What are the flows like?
Yeah, so in the gold-backed ETFs like GLD, and there's another one called IAU, and other ones even around the world that are similar. So what they do is they go out. So if you own one share of GLD, it's equal to a little bit less than a tenth of an ounce of gold. And it's interesting because it is worth less than a tenth of an ounce because it started out at a tenth of an ounce, but the GLD takes a fee out of your share, out of your ounce, out of your tenth of an ounce every year. And that's why right now it's down to like something like 0.9 something ounces in one share of GLD. But anyway, but the point is that if you buy GLD, it's tenth of an ounce. And what we've seen is that there's been a very big decline in the number of ounces in gold-backed ETFs, and that's obviously because investors and speculators and whomever market participants are selling the gold-backed ETFs. And so it's interesting, like since the end of 2020, actually, when the vaccine was released and there was a view that this COVID thing was going to be resolved, we've had around 625 million ounces come out of gold-backed ETFs, and they continue to come out this year. There have been, I think it's like 10 million ounces so far just this year, I think, have come out of gold-backed ETFs. So market participants in the U.S. and other parts of the world are saying that they don't need gold, and that's in stark contrast to what's happening amongst central banks.
Interesting points, Chris. So gold is trading around $2,000 an ounce, and it was up small in 2023, I believe somewhere between 5 to 10%. But when you look at the gold equities, they're not really benefiting from this move at all. Like most were down significantly in 2023. And if we look at Newmont, for example, the world's largest gold producer, it peaked at $85 in 2022. Now it's trading in the low 30s. It's down 20% year to date, and we're only 2 months into the year. And I can say the same thing about a number of other gold producers. The GLD is doing a little bit better. It's up small on the year, I believe around between 5 to 10%. But these equities are not factoring in this higher gold price of $2,000 an ounce. And I want to hear your opinion as to why that is.
Well, I think what's happening is that for the gold miners, what happened was that very specifically, as the price of gold went up, like I was saying, because of the money printing and the inflation that took place during the whole COVID ordeal, the cost to mine went up, and it went up at a faster rate than broader inflation because it's much harder. it was much harder to operate a gold mine than it was to operate like an asset management firm where I work, or a brokerage firm, or whatever, right? Or an advertising agency, blah, blah, blah. Because a gold mine, or any type of mine, you have to actually have individuals there on the ground. Obviously, you can't work from home. And then during the COVID ordeal, there were lots of government restrictions that caused the companies to need to socially distance individuals. Lots of mines are remote. Lots of gold mines are remote. And so what that means is that you need to fly people in and out. So that got to be extremely expensive in terms of the shift, and the rosters, and so that you had, so that you wouldn't have, in terms of social distancing and all that crazy stuff, and quarantine and whatever. And so it just got to be, and also the other thing was that, like, with all of the government stimulus and kind of like the paying people to stay at home and that kind of thing, it became a lot more difficult to entice or incentivize individuals to leave their houses when they're getting paid by the government to go, work in like the far north, like to work in the Yukon or something like that, right? So it's a long way of saying that costs went up very meaningfully in the mining sector as the price of gold went up. So margins didn't rise when the price of gold went up, and that really hurt the gold miners. So I mean, Newmont had a specific example where it did a deal with Newcrest, is no large Aussie producer. So they've had these idiosyncratic issues. You mentioned Newmont; they are the biggest, but by and large, within the mining sector, the reason that they haven't had the big run that the price of gold has had, or haven't kept up with the move in the gold price, is because their costs have gone up.
And Chris, if you look at some of the large producers like Newmont, Barrick, or Agnico, what gold price are these producers factoring in?
I mean, it's hard to say. I mean, like right now, I have maybe a good way to say it is that, like, I have Agnico, which isn't going through this like idiosyncratic issue with Newmont with the Newcrest integration. But let's just say Agnico, which is a good, solidly run company. I'd say the bellwether in the industry now, given what's happening with Newmont. Agnico is trading at around 1x its net asset value based on the current spot gold price of around $2,050 an ounce. So historically, back in good times, Agnico was trading at, like, say, at least 1.2x NAV, because they've proven in the past that they can accrete their net asset value. They can grow their net asset value. So it should trade at a premium to its net asset value. They grow their net asset value by finding more gold, by making good acquisitions, building mines, that kind of thing. So historically, it's traded, say, at 1.2, 1.25 times NAV. And right now it's trading at 1 time. So, theoretically, you could say that it's trading at a gold price which is 20 to 25% lower than the current gold price. You know what I mean? That's like one way of saying it, right? So is that because it should be trading 25% higher, it's factoring in a gold price which is 25% lower. So that would mean, I guess, if gold's at 2,000 broadly, that would mean it's what is that, 1,500? I guess maybe something like that, 1,600, something like that. I don't know. But yeah, it's factoring in a lower gold price based on historic multiples for the stock.
And Chris, do you think that the large buying that's going on by the central banks throughout the world, that they are artificially keeping the gold price up? And I guess another way to frame that question is that if they weren't buying, would the gold price be significantly lower than where it is right now?
I think so. I think it would. I mean, I think that they've been a huge boon to the gold price. Yeah, given the redemptions and sales that we've seen from the gold-backed ETF. So, but I think, I do like to look at it as a cup half full from a gold investor's perspective, in that, like, this issue with the confiscation of the gold reserves by the U.S. and the potential rise in geopolitical tensions. I mean, I think that the Chinese, frankly, probably are looking at the U.S. election in November and see that there's a relatively high likelihood that Trump's going to win. He's been he was more antagonistic towards China than Biden is. So like, it seems unlikely to me that the Chinese are going to stop buying gold now. And the Chinese central bank. And it seems unlikely to me that, again, these other central banks that have been buying are going to stop doing that. So, the cup half full is, if they keep buying, and they're pretty price insensitive, if they keep buying and, have that kind of base load demand, then if the ETFs do change and switch and start to buy instead of sell, or even flatten out, then the gold price should go a lot higher. And that's the cup half full, view of what's happening, of the dynamic now in the sector.
Chris, you made an interesting point about the U.S. election that's happening this year. And I read an article recently which discussed the number of elections that's being held in 2024. And it's referred to as the election super cycle. There's going to be over 83 elections being held throughout the world. But I'm curious to hear your thoughts on what this will mean to the price of gold.
Well, I mean, I think that it will be helpful from that perspective of the geopolitical risks and that kind of thing in terms of central bank buying. Like I said, I mean, theoretically, like, if he comes in and cuts taxes and I mean, I think that by and large it would be probably a marginal negative, because he probably would get things like more back in order, relative to the amount of spending that we've seen, fiscal spending. There probably would be less fiscal spending. So, I mean, last time around, when on like the night of Trump's election in 2016, I do remember the price of gold spiked when we saw that he won, and then but it was just overnight, and then the next morning it declined because the market had the view that that the Republicans were going to be fiscally conservative and kind of get things back in order. But I don't know. I mean, it seems like so much has happened since then, and I mean, we're even seeing now that there's this bipartisan deal. It seems Congress passed a bipartisan deal. Now we're in the Senate has to pass it, but it was overwhelmingly supported by both parties, of another tax cut, an $83 billion tax cut. And what does that mean? It's another $83 billion of borrowing. So, and again, I mean, Trump, he's a borrower. That's what he's done in his entire, commercial career, is borrow. So I think it'll really be a neutral from a fiscal monetary perspective, but I think that from a geopolitical perspective, it'll be a little bit of a positive.
Chris, you made mention earlier that gold producers are trading below their NAVs, and I want to get your opinion on royalty companies. Historically, they're always trading at a premium to their NAV. What are your thoughts on royalties here? And I guess more specifically, I'm looking at Franco-Nevada because of the Cobre Panama situation.
Well, royalties are actually big holding in our fund, and they're just great. They're ballast in the portfolio because, so just a royalty company, again, it gets a certain percentage of the revenue from a mine. So royalty companies didn't experience this big inflation that I was describing that happened for the big mining companies, or not just big mining companies, but for the producing companies. So because of that, they did really well when the price of gold went up, and they also benefit on the downside. So in a tough market like now, like a tough equity market for gold miners, they benefit because they're a source of capital. What they do is they take, so they're generating cash flow from the revenue, from the royalty revenue that they get, and they also borrow money, or they pay a dividend, but they redeploy that capital that they get, and they even borrow money and lever up their balance sheets to give to production companies or development stage companies as a source of financing, so that they can bring a project into production. And so they'll give money up front to a company in exchange for the right to a certain percentage of the revenue from that specific project in the future. So like they benefit in the upside and in the downside, and they've been great investments for us and for our clients for a very long time. But I'll get to Franco in a sec. But so in a good market, so we have to be cognizant if the market does start to turn, if we do see a recession and the price of gold runs and the recession even causes mining costs to stabilize and margins to really expand, then we have to start switching out of the royalty companies and into the production companies, because those are going to have a lot more torque to the upside. Franco is a specific scenario where, they've always traded at the highest premium. They've been the best. They've been around for the longest. It's a big holding in our fund. Their largest royalty is on a mine in Panama, a copper mine, and Franco has the right to all of the gold that this copper mine produces as a byproduct. The mine's called Cobre Panama. It's owned by First Quantum, which is a Canadian-based multi-asset mining company. It's a long story, but due to protests and various political considerations that are like totally, in my mind, just wacky things that happened in Panama, the mine was closed. So the government closed the mine, and now it's not producing. And there's a question as to whether or not it will ever reopen. I mean, it's absurd, frankly, to think that it won't reopen, but there is a distinct possibility that it won't. And so right now, if I include Cobre Panama as an asset, Franco's trading at a very big discount to where it has historically and to its peers. If I take Cobre Panama out, it's trading in line with where it has historically, which might be a little bit too high, given that it might start to trade at a discount if Cobre Panama is closed indefinitely.
Interesting points, Chris. And I'm sorry, where did you say Franco is trading on an NAV basis?
On a price to NAV? I mean, again, so from recollection, like if I include Cobre Panama, it's trading at say like 1.4 times NAV. And if I take Cobre Panama out, it's trading at around, sorry. Yeah, sorry. All right. I take Cobre Panama out, it's trading at like 2 times NAV, which is historically where it's traded, around 2 times NAV. So, or like 1.9, something like that, times NAV. So now the market seems to be pricing Cobre Panama out. But the thing is, if Cobre Panama is taken out, it probably won't trade at its historical high multiple, because the market's going to say, well, these guys got this one wrong. They got the Cobre Panama wrong. Whereas historically, it's traded at such a big, at the biggest premium, because they, Franco just gets everything right. And they have historically for the past 20 years. So that's the deal. Now, the mine was just closed, I think like November or something like that of last year. So it's only been closed for a couple months. There's an election in Panama in May. And it's huge. The mine is 5% of the GDP of the country. So again, and it's never had any environmental issues, never any there were never any leaks or out of its tailing facility. Like everything was up to not like it operated well, like very well for 3 years, I think 3 or 4 years. So it's very strange what happened there. And we're hopeful that it reopens, but we'll see.
Yes, one of the things I find fascinating about mining is the geopolitical elements. And this is one of those situations where you don't know what's really going on behind the scenes. And we don't know quite often. It comes down to money. And I'm sure that's the case here.
Well, so something's happening, which again, because it doesn't make sense. And we've heard that there were issues with again, we don't own First Quantum. But we've heard that there are issues with a union, maybe like First Quantum used like a different union from like the main union to build and operate the trucking union or something like that to operate the mine in Panama. So now this main trucking union might have been financing protests to an extent to get the mine closed, so that maybe First Quantum will use this new, this new union, this first union. And again, as it, like, look, things are screwy in the U.S. too, but like this is super screwy, frankly, and because this is like, because the company and investors have put billions of dollars into this mine, and even us. I mean, we in our holding and owning and investing in Franco invested $1 billion in this project in order to get the rights to the gold. So like, for the Panamanian government, like it doesn't look good for Panama for this to happen. And I mean, it would just be shocking for investors to put more money into the country, given what's happened here. Extremely opaque and strange. So hopefully, again, they get it sorted. But yeah, I mean, these are the things, again, that we have to really. It makes it very interesting for us, obviously, for me as a portfolio manager to try to figure out all these ins and outs and risks of all these various jurisdictions.
Chris, I have to get your opinion on Bitcoin. We can't have a discussion on gold without talking about Bitcoin. And the SEC recently approved 11 Bitcoin ETFs, including some associated with the largest fund managers in the world, Fidelity and BlackRock. And I want to get your views on maybe this is another reason why gold is not performing the way you would expect it would. Do you think Bitcoin is taking away a lot of capital from the gold trade?
Yeah. I think so. So Bitcoin, I mean, what do I think? I think number one, I mean, sure, it's taken away some interest from gold, and so it has been a headwind to the gold price. Will it continue to be? I'm not sure. I mean, I think it'll be amongst like a younger cohort. I think maybe 40 years old and younger. There might be this aspect of like, sure, let me have some Bitcoin instead of gold. I think though most people in Bitcoin now are in it from a speculative perspective and haven't really thought about the big cosmic elements of Bitcoin relative to it being an asset which is rare and not replicable and nobody else's liability. I think that's what got it started. Like digital gold is what they were calling it originally. But I think what's really got it moving has been just speculators who have no concept of any of that. So, I mean, so it's been let's say a marginal headwind. I do think that at the end of the day, what's happening is gold right now is the reason that money's coming out of gold ETFs is because, number one, we're having this Goldilocks scenario, or this narrative of this Goldilocks. But number two is that higher rates do cause an opportunity cost to holding gold, which yields nothing, right? So it's a natural correlation to see savers sell some gold when interest rates go up and maybe put that into a money market fund, which is right now yielding, like we have a money market fund here, which is yielding 5.3% or 5.4%. And it's all U.S. Treasury money market. So like, there is that element of it. So I think gold's kind of been doing what, in terms of the ETF flows, it's been doing what it probably should have been doing, or it's been doing what makes sense, from a correlation perspective relative to interest rates. But from a Bitcoin, I just think that it's going to be like, my big picture on Bitcoin is that, like, number one, again, the central banks are going to buy gold, and are buying gold. Number two, if we do in fact have a severe inflation in the United States, a hyperinflation, something similar to what's happened in Argentina. Argentina dollarizes its economy. The United States, if there's a hyperinflation here, we can't dollarize our economy, and we're not going to like tie our currency to the Canadian dollar, Jimmy, or the or the euro or the Mexican peso. What are we going to do? We would tie our currency to gold because we have the biggest reserve. We have 8,300 tons of gold. So like, or peg our currency to gold. So So like gold is this, and when people, I guess the big picture point is when people start to realize, start to think in that cosmic way about gold, what it really is, the qualities that make it what it is, I think that they'll go there instead of Bitcoin. So I'm confident that that gold's going to maintain its position, notwithstanding that this kind of speculative interest in Bitcoin.
Yes, there's nothing better than gold in the hand.
Exactly, hard asset, right? You can drop it on your foot and it actually hurts, right? So you know it's there.
Chris, a lot of the discussion so far has been focused around the retail investor and why they're not buying gold and gold equities and why they're trading at big discounts. But I'm sure you're aware of the fact that Costco started selling gold bars in the latter part of 2023. And during their last quarter, they made mention of the fact that they sold over $100 million worth of gold, which is quite a bit. And they have 72 million members. So there could be huge demand coming from these members. But I'm curious on why you think Costco started selling gold, and also what does this mean when you see this amount of people buying gold?
Yeah, I mean, I think that's actually a really great point. It's very meaningful. I mean, I think because it does come back to the whole like what I was saying in terms of interest rates and GLD flows, and that I think that there is some element of that being retail, like the GLD flows relative to interest rates. But I think it's also correlation trades. Like GLD is very liquid. I think it's something like $55 billion in GLD. It trades all the time, very, very liquid. Again, I don't know the billions of dollars it trades today, but I do think that like that algos and that macro funds use it as a way to kind of manifest another trade. So meaning like how do I bet on higher short-term rates, and they'll do that through selling or shorting GLD. But when you look at the retail, like the average mom and pop on the street, they do feel that something's not right. They do understand. They're like, wait a second, why have things gone up so much? Why, like what was happening where they were just sending me checks in the mail, like, oh, like or my buddy was paid to stay home and not work, and then he was trading Bitcoin, trading, but like this just doesn't feel right. And um and and I think that that's being manifested in the purchase of all this gold at Costco. Walmart has started selling gold, and what's noteworthy also is that Costco says that they sell out like really quickly. Like who knows how much they could be selling if they were to really stock it there. So I think that that it is meaningful, in that the average man on the street in the US does understand that, or does have a feeling that things just are really unsettled, and they want to have that hard asset.
Very good point, Chris. And I also shop at Costco, and every time I go there now, I'm dropping $500 and I'm not buying any gold bars. But I can't get over the rate of inflation that we are now experiencing throughout the economy. And even though the government says it's only running around 3 to 4%, I don't believe that for 1 second. I think it's significantly higher. But what are your thoughts on that?
Yeah, I mean, I have four kids, and and they eat a lot, and and like, yeah, it's so expensive to go to the grocery store now. And it just, yeah, and it's just not, it's not adding up. And you see the price of things like, a bag of chips is $5, and um it's not adding up. People see that, you know what I mean? Like, and they're like, wait a second, let me just have a little bit of gold here. So I think it makes sense. I think it makes sense.
No, and thank God the price of oil is hanging around in the low 70s, because if it were to break above 100 or 125, man, we would be in for some real trouble.
Yeah, exactly. Yeah.
So, Chris, I want to move the discussion now toward what you're hearing from investors and advisors. I know you speak to a lot of investors on a regular basis, but I'm curious to hear what you're hearing from them just in terms of gold versus Bitcoin debate.
I think that by and large, what's interesting, I mean, I think by and large, they ask the question. I mean, and by and large, also, in the advisors who are established are older. They're like my age or older. I'm 47, right? So um, so they are kind of like, what about Bitcoin? They aren't saying that they'll have Bitcoin over gold, but they're just asking about it, kind of like you did. Um, but there are younger ones, I was telling you before. I have a friend who's a very successful advisor in New York City, um, and I spoke to him about gold a couple of like maybe 2 years ago now, and he was saying, he's like, no, I'm not in gold. I'm in Bitcoin. I'm in crypto and that kind of thing. So, I mean, there is that age kind of like bifurcation there, I think, to an extent. But I think that people do realize, like, again, the conversations by and large are just like they realize that gold has been around, obviously, since the beginning of time, and there's some value to that. Do you know what I mean? So I mean, it's more questioning now than a firm, forget gold, I'm with Bitcoin.
Well, Chris, that was a great discussion on gold and gold equities and what the benefits are in terms of owning it in your portfolio. As we wrap up, if an investor would like to learn more about you and your thoughts on gold or learn about the Gabelli Gold Fund, where can they go?
Well, I mean, actually, you could email me directly. I'm cmancini@gabelli.com, and I'd be happy to get emails from you. Um, and you could also call 1-800-Gabelli. And if you have any questions, like if you'd like to invest in the Gabelli Gold Fund, we'd obviously be thrilled, and you could call them, and they could help you out. They could answer questions. They could even put you in touch with me. If they can't answer your questions, I'd be happy to talk to you, actually. And yeah, and also, like, if you're on like Fidelity or Schwab or whatever, the Gabelli Gold Funds, the symbol there is GOLDX.
Well, Chris, after giving out your personal information, you might be inundated with emails and phone calls.
I mean, it's interesting, that's fine. I look forward to the questions, and we'll see how they come. I don't have to answer them, right? But you can still send them. No, but I will answer them if you send them. So yeah, we'll see what happens.
Well, Chris, that was a great discussion. I want to thank you very much for making time today, and I look forward to our next discussion.
Okay, yeah, sounds great, Jimmy. Anytime.
Well, I hope you enjoyed that discussion with Chris Mancini and you gained some insight into the benefits of owning precious metals in your portfolio. One of the reasons we do these interviews is to help you determine where the economy is going and also determine the impact that certain assets will have on your portfolio. And if you need help in understanding what's happening in the economy and also how to structure your portfolio, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com. There's no obligation to work with any of these advisors. It's a free service that Wealthion offers to all of its viewers. Once again, I want to thank you very much for spending time with us today, and I look forward to seeing you again soon.